Hello everyone, my name is CMA. Welcome back to CMA modules. Today we will be recording a video lecture on accounting cycles analysis of transaction. The accounting cycle is a sequence of activities performed by an accountant to document and report an organization's financial transactions during an accounting period. This cycle follows financial transactions from when they occur to how they affect financial documents. So we have accounting cycle. Accounting cycle is a sequence of activities. Okay, what is accounting cycle? Is a sequence of activities. Now, for example, today I'll perform some. Suppose today I'll sell a transaction. Okay, I'll initiate sale. So I'll sale. Then I'll have to record that bill into my book. Then I'll have to journalize that journal. I'll have to post it in the ledger, respective ledger. That ledger I'll have to convert it to trial balance to balance sheet. So this will be repeated for every transaction. So that is nothing but accounting cycle. Okay, so accounting cycle is a sequence of activities performed by an accountant. Sequence of activities, I mentioned the sequence also. Sequence of activities which are performed by an accountant to document and report an organization's financial transactions during an accounting period. This cycle follows financial transactions from when they occur to how they affect financial documents. This cycle follows what? Financial transactions from when they occur to how they affect financial documents. The entire process starting with identification of transactions, the recording and processing all transactions of an organization to its representation on the financial statements and also to closing the accounts if applicable is referred to as accounting cycle. So closing books of accounts, identification, processing, recording, all these things are covered under accounting cycle. Okay. To keep track of full accounting cycles from start to finish is one of the main duties of a bookkeeper. Then we have stages of accounting cycle. Accounting cycle consists of following sequential steps: identifying transactions, recording transactions in books of original entry, posting to the ledger, drafting of unadjusted trial balance, passing of adjustment entries, drafting of adjusted trial balance. So we have stages of accounting cycle. ऐसे ही हो जाता है, चलो मैंने इमेजिन किया आई वांट टू गो फॉर एंड ऐसे ही हो जाता है. नो, देयर आर स्टेजेस ऑफ stages under accounting cycle. You first identify your transaction. Okay, whatever happens, you identify your transactions. Then recording transactions in book of original entry. The first step is in accounting cycle is to identify, is to analyze event to determine if they are transactions. Now I'll go to my friend's birthday party and I'll give her 500 rupees. Okay, that is not a transaction. But I'll visit her and I'll give her 500 rupees for services which she has provided. That is transaction. So you identify whether this event is a transaction or no. Transactions are starting point from which the rest of accounting style cycle will follow. So transaction, identifying whether it is a transaction or no, that is very important because that is the starting point. From there, everything else will start. Recording transactions in the books of original entry. The second step in accounting cycle is to record identical transactions in the relevant books of original entry as journal entries. So second step in accounting cycle is what? Second step in accounting cycle is to record identified transactions. Second step in accounting cycle is to record identified transactions in the relevant books of original entry as journal entry. So what you do, you take your second step. Your second step is what? In the accounting cycle is to record identified transactions. Second step is to record identified transactions in the relevant books of original entry as journal entries. Posting to the ledger. The next step is to record a summary of activities in relevant account in the ledger. Drafting of unadjusted trial balance. At the end of accounting period, data from the ledger accounts may be taken to draft a trial balance. It is prepared for identifying any errors that may have occurred during initial stages of accounting cycle. However, this step is not mandatory. Then we have passing of adjustment entries. So if you see, I'll give you a briefing up to 4 points. First, to identify your transaction. Then you record your transactions in books of original entry, that is journal entries. Then you post them to ledgers. Then what you do, you prepare unadjusted trial balance. Okay, same thing we studied at the start of this lecture. Passing of adjustment entries. Now some accounts are not getting tallied. I have missed out. I have instead of writing as 30, I've written it as 3 lakhs, and there's a gap of 2 lakh 70. How to adjust? So pass adjustment entries. Passing of adjustment entries, identification of necessary adjustments, and passing of adjustment entries make up the fifth step in the cycle. Drafting of adjusted trial balance. Once all adjusting entries are completed, then all adjusted trial balance can be prepared. This happens to be the last step before preparation of financial statements. Closing of books. In this stage of accounting cycle, ledger accounts are closed and balanced at the end of every accounting period. Closing of books. In this stage of accounting cycle, the ledger accounts are closed and balanced. Correct. So we have first we identify the transactions, whether they are transactions or events. I mentioned that I visit my friend for her birthday and I give her 500. That is not a transaction. Okay, but at the same time, if I have taken any services from her and I visit her and I'll give her 500 rupees, so that's a transaction. So identify the transaction. Then what you do is then record your transaction in the books of original entry, then posting to the ledger, drafting of unadjusted trial balance, passing of adjustment entries, drafting of adjusted trial balance, closing of books, and then drafting of financial statements. I'll take a pause, a quick read, then we'll go for next. So same thing they have represented in a diagrammatic format. Then we'll start from events and transactions. Events and transactions. Primary purpose of financial accounting is to record transactions entered into by an organization during an accounting period. So that's the primary purpose. What is the primary purpose? Whatever transactions you are entering into, that you please record. Okay, now suppose I am entering into a transaction with Mr. A for 10,000 rupees. Please record. Mr. B 15,000 rupees. Please record. So transactions are the starting point of accounting cycles. Transactions are created through events, but all events are not transactions. Transactions are created through events, and all events are not transactions. Events, everything that is happening in every moment of human life is an event. Simply stated, any happening is an event. As such, event can be financial and non-financial. Financial like purchasing a book, paying a cab fare, receiving a check. So that's event for me. Okay, financial events. Non-financial events, visiting a bookstore, going for a morning walk. So they are non-financial events. An event may involve any number of parties and may be complete and may be incomplete. Okay, events can involve any number of parties and may be complete or incomplete. So they can give you define events. Okay, or they can give you a transaction and they'll ask you to identify events or whether it is event or transaction. Then we have transactions. An accounting transaction is an event which has a monetary impact on financial position of the organization. In order to be considered as a transaction, an event has to satisfy following conditions. It must be measurable in terms of money. Event must be measurable in terms of money. If it is measurable in terms of money, it is transaction. It must involve at least two parties. It involves a monetary exchange for goods or services. It must cause a change in financial position of the entity. So we have events, we have transactions. Analysis of transactions. An organization enters into various transactions during course of its operations. These transactions cause changes in financial position of the organization. Analysis of transactions implies observing the changes in financial position of the organization caused by transactions entered into by it during an accounting period. Change in financial position means a change in one or more of five basic elements of accounting, they being asset, liabilities, capital, equity, expenses, and revenue. So we have analysis of transactions. An organization enters into various transactions during course of its operations. An organization does what? An organization enters into various transactions during course of its operations. These transactions cause changes in financial positions of the organization. Analysis of transactions implies observing the changes in financial positions of the organization caused by transactions entered into. So, what we are doing is we are analyzing the transactions. What are those transactions? Whether they are asset, whether they are liabilities, whether they are income, whether they are expenses, capital in nature, revenue in nature, I'll identify. Identification is very, very important. Assets and liabilities shows my position. Income and expenses shows my performance. In the following example of a trading proprietorship business, various illustrative transactions are used to understand the changes in different elements of accounting. Transaction 1, Mr. Suman Day commences his business by investing rupees 5 lakhs in cash. Changes brought about by this transactions are cash increases in the business by 5 lakhs, capital increases by 5 lakhs. So explained there, they have taken few examples of transactions and they have explained that transactions should be recorded, and those transactions will how they'll impact our financials. They'll give an increase in asset, increase in liability, decrease in asset, decrease in liability, increase in income, increase in expenses. So that way they have explained, they have taken few examples and explained the transactions. Okay, so a quick read to those transactions. I'll move ahead. Such analysis of transactions helps in identification of accounts which would be involved for accounting purposes and also helps in identification of debit and credit aspect of every transactions. We have analysis of transactions. Okay, such analysis of transactions helps in identification of accounts which would be involved for accounting purposes and also helps in identification of debit and credit aspect of every transaction. Okay, then you have chart of accounts and codification structure. The primary purpose of financial accounting is to record the transactions entered into by an organization. So what is the primary purpose of financial accounting? Primary purpose of financial accounting is to record transactions entered into by an organization during accounting period. So whatever smallest, even if you buy safety pin, no, you have to record here. To achieve this, various accounts are opened and after the classification exercise, the transaction get posted in the ledger. This happens to be the building blocks for developing the financial statements and other management reports of the organization. However, with increase in complexity of business and flow of data, it has become quite a challenge to retrieve the information stored in the accounting records. It is for purpose of effective management and retrieval of already recorded accounting information. Chart of accounts are developed and they are codified. So chart of accounts and codification structure. Okay, so the primary purpose was what? To record transactions. After recording transactions, you classify them. Classification is very, very important, or it is equally important. With the help of classifications, you'll come to know that your assets, what is the position of your assets, your income, expenses, liability. A quick read, then we'll go for chart of accounts. A chart of accounts is a listing of all accounts in general ledger, each account accompanied by a reference number. It is financial organizational tool that provides a complete listing of every account in the general ledger of the company, broken down into subcategories. Specifically, it is an index of all the final accounts in general ledger of an organization. So we have chart of accounts. So what is chart of accounts? Listing of all accounts in a general ledger. What we do is we list out all accounts in a general ledger and each account is accompanied by a reference number. So that is chart of accounts. Chart of accounts is a driving force behind an organization's bookkeeping and accounting systems and is considered to be foundation of financial reporting. The basic purpose of such charting is to organize accounts and group similar ones together. It is used to organize finances and give the stakeholder a clearer insight into company's financial health. This process makes it easier for the user to locate specific accounts. A well-structured chart of accounts is often the single best and most effective way to raise financial reporting of an organization to next level. So we have chart of accounts. How does chart of accounts helps us for reporting? Financial reporting, how it creates a foundation, it creates base for our accounts, creation of accounts. Then we have codification structure. A chart of accounts provides a structure for general ledger accounts of a concern. It lists specific types of accounts, describes each account, and includes account numbers. A chart of accounts typically lists assets accounts first, followed by liability and capital accounts, and then by revenue and expense accounts. Setting up of a chart of accounts. To set up chart of accounts, the first is to define the various accounts to be used by organization. Each account should have a number to identify it. Each chart of accounts typically contains a name, brief description, and an identification code. So we have chart of accounts. Chart of accounts provides structure for general ledger accounts of a concern. So chart of accounts does what? Okay, how do we codify? Setting up of chart of accounts, ordering of accounts, designing of chart of accounts. Four head points are discussed here. Illustration of accounts, codification for a small business organization. For a small business, the three-digit code may suffice for account number. Although more digits are desirable, however, in order to allow for a new account to be added as business grows with more digits, new accounts can be added while maintaining the logical order. Complex businesses may have thousands of accounts and require longer account reference number. So we have illustration of accounts codification for a small business organization. So for a small business, three-digit code may suffice for an account number. Three-digit code is sufficient for an account number. Although more digits are desirable, however, in order to allow the new accounts to be added as a business grows with more digits, new accounts can be added while maintaining the logical order. Complex businesses may have thousands of accounts. So you can add new accounts, you can maintain in a logical manner. Complex businesses have thousands of accounts and require longer account reference numbers. As such, it is worthwhile to put throughout into assigning the accounts numbers in the logical way and to follow any specific industry standards. Okay. Following is an example of some of the accounts that may be included in the chart of accounts and reflecting how the digit might be coded. So you have 1000 to 199. So that is related to asset accounts, then liability accounts. So based on this, you go for your entries. Okay, I'll take example of Tally software. So under Tally software also, you for creating any entry, you can use this also, the accounting number. Okay, accounting codes, you can use that, and then you can go for your entry. Okay, so this is nothing but accounting codes. An alternative presentation of typical chart of accounts is as follows. So you can present it in this way also: balance sheet accounts and income statement accounts, relevant for theory only. Only for theory purpose it is important. Accounting equation. Accounting equation is a representation of how the three important components of accounting, namely assets, liabilities, and equity, are associated with each other. In most specific form, the accounting equation is presented as asset equal to liability plus equity. Asset means what? Liability means what? Equity means what? So asset represents valuable resources controlled by company such as cash, accounts, receivable, fixed assets, inventory, etc. Liabilities represents its obligation of an organization. to its external stakeholders, while equity represents owners' net claim on the assets. It is to be noted that liabilities and equity represents how the asset of the organization has been financed. So we have assets. Assets represents valuable resources controlled by the company such as cash, accounts receivable, fixed assets, inventory. Then we have liabilities. Liabilities represents its obligations of an organization to its external stakeholders. Correct. Assets will represent what all the valuable possession. Okay, so in form of cash, in form of accounts receivable, fixed assets, inventory. Liabilities will represent external stakeholders. I'm liable to pay to Mr. A, my creditors. I've taken loan from the bank. Equity is nothing but my capital, represents amount or owner's net claim of the asset. It is to be noted that liabilities and equity represents how the assets of the organization has been financed. All three components of the accounting equation appear in the balance sheet, which reveal the financial position of an entity at any given point in time. Expanded accounting equation. The above equation can be further expanded by incorporating various elements of equity component as under. So they have given us accounting equations. Assets equal to liabilities plus equity. So capital plus your liability will give you the total, and that total will be your total asset, will be equal to your total asset. Assets equal to liability plus capital plus revenue minus expenses minus drawings. So this is nothing but accounting equations they have given you. They are important for numerical problems ahead. This equation is considered to be foundation of double entry accounting system. At a general level, this means that whenever there is a recordable transaction, the choices for recording it all involve keeping the accounting equation in balance. So this is what this is related to expanded accounting equation. So what they are mentioning, this equation is considered to be the foundation base for double entry system. At general level, this means whenever there is a recordable transaction, the choices for recording it all involves keeping the accounting equation in balance. A quick read, I'll take a pause, then we'll go for illustrations. Illustrative accounting equation transactions. The following table shows a few of the common accounting transactions and their recording within the framework of accounting equation. So we have transactions, we have assets plus expenses plus drawings, we have liabilities plus capital plus revenue. So we have cash introduced by proprietor. So cash introduced by proprietor, cash increases, capital increases. So asset, see what they have done is they have clubbed all debit items. So asset, expenses, drawings, liability, capital and revenue. Cash introduced by proprietor, purchases of goods in cash, inventory increases, cash decreases, purchase of goods in credit, inventory increases, creditors increases. So they have given you illustrative examples. So if you purchase goods, so you'll have a decrease in cash because it will be you'll have to pay debit credit what goes out, cash is going out, stock is coming. So purchases will be debited, so your stock will increase. So increase in stock, decrease in cash. So that way they have explained few transactions here. You can have a read. Double entry system of bookkeeping is an accounting system which recognizes the fact that every transaction has two aspects and both aspects of transactions are recorded in the books of accounts. Correct. Every transaction has two aspects. It is a fundamental concept encompassing accounting and bookkeeping in present times. Double entry system records transactions by understanding them as a debit item or credit item. A debit entry is one account gives the opposite effect in another account by credit entry. This means that the sum of all debit accounts must be equal to sum of all credit accounts. This system is based on accounting equation and requires every business transactions is to be recorded in at least two accounts. The total debits recorded for each transaction is to be equal to total credits recorded. So we have double entry system. So what is double entry system? Double entry system of bookkeeping is an accounting system which recognizes the fact that every transaction has two aspects, debit and credit. Both the aspects needs to be recorded. A quick read, then we'll take rules of debit and credit under double entry system. The double entry accounting system is based on specific rules of debit and credit for recording transactions in the accounts. The rules of debit and credit can be explained by applying two methods, golden rules and accounting equations. Successive processes of double entry system. Firstly, transactions are recorded in the books of original entry, that is journal and other subsidiary books. Secondly, transactions are classified in the suitable manner and recorded in another book of accounts known as ledgers. So first what we do, we record our transactions in the books of journal, original entry, journal or subsidiary. Then from there we take it to ledger. Thirdly, arithmetical accuracy of the books of accounts may check by means of drafting of trial balance. Finally, the results of operations of accounting period is ascertained through drafting of income statement and financial positions of entity at the end of accounting period is reflected through balance sheet. So we have transactions are recorded in the books of original entry, that is journal. From there you post it to the ledger. From there you post it to trial balance. And finally, you prepare your income statement and balance sheet. Now you have books of original entry and subsidiary books. Simply stated, books of original entry refers to accounting books in which transactions entered into by an organizations are initially recorded. These are primary books of accounts which are used by an accountant for recording transactions in the first place. So books of original entry. What are books of original entry? Books of original entry is nothing but refers to accounting books, technically called journals. They are books of original entry. You go for your primary recording, in which transactions entered into by an organization are initially recorded. These are the primary books of accounts, which are used by an accountant for recording the transactions in the first place. These are also referred to as books of primary entry or books of first entry. Whenever an event is recognized as a transaction, it is entered into accounting system of an entity by first recording it in journal. So we have whenever an event is recognized as a transaction, it is entered into by an accounting entry of an accounting system of an entry. So whenever an event is recognized, what you do is you go for journal first. With the help of supporting, you record in the books of journal. The transactions are recorded in the journals in the form of individual entries. Transactions are recorded in a chronological order, how they occur, 2nd March, 3rd March, 4th March, 5th March, how they occur in a chronological order they record. Transactions are recorded in the journal in the form of individual entries as and when they occur in a chronological order. As because transactions are recorded on daily basis, the books of original entry are also referred as day books. Information in these books is thereafter summarized and posted in the ledger accounts. So this was books of original entry and subsidiary book. Then we have types of original entries. So books of original entry are broadly classified into two categories. First one is special journals, that is day books. Acha, I sold it to Mr. A, recorded. Mr. B recorded, Mr. C recorded. And general journal, posting in ledger and finalization of accounts. After the transactions relating to a particular accounting period have been recorded in the journal or subsidiary books, they are posted in respective accounts in the ledger. At the end of accounting period, the ledger accounts are balanced and closed. The closure of ledger accounts is based on the nature of respective accounts. So posting is very, very important. Once you record in your journal, then you are required to post in the respected ledger accounts. Posting is very, very important. Correct posting is important. Correct posting will help you to know the exact figure of assets and liabilities, profit and loss. A quick read. We wind up here. Hope you like the lecture. Thank you.